Now shifting the focus into emerging markets, Asia in general. And before we get into it, we'd also like to remind you, please like, share, subscribe. We've had some good back and forths in the comment sections. There's no right answer. Everyone's, there's two ways to a market. So everyone's going to have their view. It's always nice to have an educated discussion about, what are you seeing? What are you thinking? How do you think that plays out in the market? And this makes everyone better, in my opinion, to have this positive discourse. So and before we jump back in, just a reminder, we have our big report coming out next week. There will be a big China section and international liquids and NGL section, where it's going to look at some of the things that are happening. And then China is going to be more economic and really kind of where some of those shifting patterns are, and that will be tied into NGLs and other. And then obviously it'll be a huge focus on the U.S. fracking, oil field services. What does it mean? How are things going to change? And just what does that activity look like, not only into the end of 2020, but also into 2021. So when we look at, fund flows, because what drives the world now more than just money flows sloshing around, here you can see emerging market equities had a huge inflow as we headed into November. And for anybody looking in the market here, you can clearly see it. The problem that I have and the random joke is, so we have money flowing into emerging markets. We have U.S. stocks at all-time highs. You have Europe going to highs. You have Japan at 1991 highs. You have China at highs. You have all these markets at highs, but where's the money coming from, or is it just being created? And this is where we start coming into liquidity, quantitative easing. Where are these different backdrops? And it's interesting because when you look at the U.S., for an example, everybody's long tech. Nobody's underweight tech. Everybody's over long tech, but yet tech continues to drive higher. And it always comes to, who is the incremental buyer? Where is the incremental buyer coming? Because when we look at this, they are buying debt. They're buying debt, they're buying emerging market debt, they're buying emerging market equity, and they're buying Chinese equity. So clearly there is flows that have been accelerating, obviously since the summer, but has really taken off. And is it a flight to yield? Is it people are looking at COVID cases and saying, well, the activity's getting better in these locations, so let's try to get in on the ground floor, because then people will follow. Excuse me, these are things that we continue to see as fund flows matter the most when we're looking at how is the market positioned. Now, tying this back into America and kind of the most important trading partners, we've done segments looking at trade with India, trade with China, and this just gives it a backdrop looking at year-to-date top U.S. trading partners for goods only. Mexico, Canada, China, Japan, Germany, again, looking at just the U.S. dollar, where is the U.S. dollar sitting? And these are things that we're always looking at. And now the Chinese one is an interesting one because, Biden was asked about in his presidency, what is he going to do with the phase one trade deal? We have shown so many times in writing, in reports, on how that trade deal just doesn't exist. China's going to miss the mark by so much that you might as well just ignore it or just restructure it and just change the numbers. But when we look at it, Biden was, I think, fairly smart in saying, look, we're going to look at everything. We have to assess what were the benefits, what were the drawbacks, what worked, what didn't work. And when we get into January, we'll get a more color. But right now, tariffs and the phase one trade deal will stay in place. It's not like he's inaugurated and then week one he takes it all back. No, there's going to be a process. And it's, as we've said, I think it was 2 or 3 weeks ago, when we look at President Obama and where things were trending, and we talked about it in some of the comments, and I'll post it again, the trend was always in this direction in terms of a trade war, Cold War, some sort of friction on a trade level. And trade is really a weapon and it's a weapon of war. And people, I think, sometimes forget that, because war doesn't start hot. Typically it starts with a trade embargo, it starts with some trade battle, and then it escalates. And I can give examples in terms of U.S. Germany, Nazi Germany, U.S. Japan, how this all works. But regardless, it's all I'm saying is Obama got much tougher on China by the second year of his second term. And Biden was there, and we saw the pressure. We saw the internal pressure. I mean, most of America wants to be tough on China, so there is going to be that mantra, which I don't think is going to that can't be lost when we're considering how is Biden going to tackle China. I think everyone needs to kind of back up a second and look at. There's going to be no rush. Things are in place, and then we'll look to see what works and what doesn't. Now, obviously, Japan is also a big component, and Japanese business investment has continued to weaken. So when we look at CapEx year over year, things have gotten a little bit softer. But even though CapEx has gotten a little bit softer, as we talked about in last week's episodes, some of the Japanese data did get better, where we had some benefits in same-store sales. We had some things happening on the level of exports, imports, just looking at this industrial production beat estimates. We had retail sales, slightly above estimates. We had a jobless rate, getting a little bit better. But again, spending. So this is looking at, again, at CapEx. Even though it's negative, it's, estimates for capital spending ex software was supposed to be down 11.7%. It's down 11.6%. Capital spending year over year was supposed to be down 12.1%. It was down 10.6%. Again, these are things that are showing a little bit of a benefit going forward as Japan is trying to turn a corner. It hasn't quite done it. It's more flatlined. And the question is, can they break it to the upside? And when you look at their trade and their, I struggle to see how quickly they can get that to a more normal level, just given the headwinds that are persisting. South Korea is one that the manufacturing PMI is up and out, which is, again, a net positive. And when we look out at the data that we've seen overall, you can see that things have gotten a little bit better. Trade has improved. When we look at industrial production, it beat estimates. Industrial production year over year, slightly worse. But month over month, they're, again, moving in the right direction, which is being reflected in the manufacturing side. GDP was expected to be 1.9%, came in at 2.1%. Imports, as we talked about last week, so imports were slightly better, but exports were weaker. And this is where we start to see some friction, because China's exports have gone up, but when we look at Japan, Germany, and South Korea, their exports are either missing estimates or slightly positive, but not as positive as we'd like. And this is where the friction comes in, and how quickly can we normalize, because these are countries that are exporting nations. Now, this is looking something positive for what could happen going forward. But again, we're hoping to see some of these export numbers. But again, a positive, it's just we need to see it reflected on the export side to really see that the benefit to the South Korean GDP numbers and inherent growth. Now, when we're looking at U.S. dollar versus yuan, what does it look like? How are things changing? What does this mean? The trend has been, we've had a downward trend. It's been a trend line that has been kind of protected by the PBOC, and we continue to see things tighten. Now, we'll talk about yields and how the yields have changed in China itself, but it's important to recognize that we've been here before, and they'll do things to try to weaken the currency and try to weaken against the dollar, but it's the dollar weakness. The dollar continues to be under pressure, continues to be pushed lower, and other things continue to strengthen against it. Now, not all currencies, because some currencies continue to weaken against the dollar, but when we look at the yuan, when we look at the euro, the yen, that's the strength that we continue to see against the dollar. And again, as the dollar weakens, exports get more expensive. So this would hurt overall Chinese exports. If you think about coming full circle to trade partners with the U.S., with China being number 3, this would be a big hit to them if we can't afford as much or we don't buy as much. Now, looking at the Chinese official numbers, again, this is coming back to the Caixin manufacturing PMI, 54.9, the manufacturing PMI, 52.1. We will get updates. They continue to be in expansionary territory. Obviously, the drops were precipitous, and then there was a quick snapback. The question is now, how much of this is that supply side, demand side? We've seen demand continue to be soft in China itself. Retail sales have gotten better, but investments have weakened. Industrial investment has weakened. It's still gotten positive, but not positive to these levels. So the question is, how much can this be maintained if we start to see and we continue to see some slowdowns, not only in imports, but also in exports? And that's going to be the correlation to watch to see how much of this ends up sitting at the port. And if it's sitting at the port, then the whole supply chain has to slow down, which again is going to become a bigger issue, especially as we see some of the sloppiness, or at least I shouldn't say sloppiness, the size of the swings that we saw in 08, 09, and 2010 until we got into more of a normalized function going forward. Now, when we look at India is now quote unquote officially in recession. Recession is technically a 2 quarters of negative growth. I don't think this is any surprise to anyone that they had negative growth in the quarter, given where everyone else is. But you can see that this is the first time that they've ever been in this situation, with the weakest being in 2008, which obviously isn't a surprise to anyone, and then again in 2001. So it shows just the sheer size of the impact, and which is why I continue to point to how quickly can we really get out of this, given the massive drop that we've seen in some of these key markets. Now, what made up the decline? And this is always important to appreciate what is making up the reductions. And we've seen government spending has declined. Investment was the biggest one, and that's the one to watch, where investments continue to weaken. And it's just because people are trying to preserve capital, CapEx, and this comes full circle to debt. If I have too much debt, how can I borrow more to invest when my revenues are under pressure? And this is, again, the debt acting as this headwind to normal corporate function. And this is, going to continue to crop up and is going to be a bigger issue overall. And then obviously private consumption has remained weak and has started to recover a little bit. But as we talked about in our first segment and in the EIA show, consumer confidence is waning. You're starting to see an increase in cases. People just don't feel as comfortable, which is going to limit some of the additional spending, which is going to stay negative. And then, but then net exports remained as a net positive. It's just the net positive isn't acting as much just because the Indian economy has grown. Investments in private consumption has become a bigger part of it. It's just, inflation is a fear. Inflation is a problem. And if inflation is a problem, then how quickly can they issue, government debt? How quickly can they get back to normalcy? And the government is going to be hamstrung based on how much can they borrow and then how much can they actually put back into the market. So here, when we shift to looking in India in general, and I just like to look at, okay, who's moving where? Who's moving what? Is it diesel? Is it gasoline? And this is something similar where when we're looking at rail freight, rail passenger, air cargo, port, and motor vehicle, this is just highlighting just that we're still not seeing this normalcy, because this is also picking up October. So when we look at October gets better because the festival season started, people went out and went about, and then it slowed back down in November. But we're seeing rail freight, starting to increase, which is a positive for diesel, but we're also seeing port volumes increasing, which is, again, supporting for diesel. Trucking has started to decline in November. So we get this push into October and then a decline into November, which will persist into December. Not at the same rate. It won't be another decrease down. It'll just be more of a sideways movement. But the one thing that I think is a bigger issue is where the port volume's going, because you can see the slope remains gentle and we're starting to see a little bit of a slowdown. And the other one is motor vehicle registrations. How quickly are people buying cars? This has always been a bright spot for gasoline demand, and it's just we're seeing that slowdown where people, again, aren't spending as much, getting a bit more cautious, which is going to limit the amount of GDP growth that we can expect going forward. Now, we've talked about food, and I think it's important to appreciate, well, how do we grow our food? How do we make sure it's sustainable? And GMO, or genetically modified, has been a a means of doing that, making something that is drought resistant, pest resistant, fungal resistant, things that have natural properties that are built into the DNA of the seed in order to increase yield. And this just gives you an idea of the sentiment of who believes it's unsafe versus safe. The issue is going to be, obviously the U.S., the global population is rising. There is more mouths to feed. We've seen an increase in overall pricing on food, as we talked about with inflation in the U.S. and Europe. We've talked countless times. I mean, we have whole episodes dedicated just to food. The issue is going to be yield. Do we have enough food for the people that are coming to? And GMO is a way to address that. It may not be the best way, it may not be the only way, but it is a way to address it. And you can see at who is willing to accept that type of functionality. And I just think it's an interesting thing to consider as we look to maybe roll out more GMO to try to offset some of the increased yield, try to capture some more market share. And this is going to be a bigger fight as we go on and we see climate change impacting and rainfalls adjusting and yields adjusting. Do we start to see greater adoption of that GMO? Now, looking at China, obviously we talked about the composite PMI, manufacturing PMI. The manufacturing, all of them, again, surprise to the upside. The question is going to be the longevity of this and supply versus demand. Because, again, we've seen the exports. China has taken export market share, and that has been a nice bright spot for Chinese exports. But we've seen demand remain slow within the country itself. Again, pushing that dual circulation system, and we follow Trivium, fantastic research, highly recommend it, and they bring up an interesting point because. Obviously it came out of the plenum. It becomes a focal point because now it's a matter of drilling into not only the populace but also the world's head, that this is the new status and the new drive for China. But when we look at the dual circulation system, it continues to it got pushed at the ASEPN conference. It's gotten pushed at all the different conferences that either Xi and Liu and everybody that has spoken at, trying to drive home the importance of the local consumption of China and trying to reiterate to India and others in the region how important the Chinese consumer is to the global construct. The problem, the thing that we continue to see is their demand remains diminished, and it started to come back, and this is why when you look at these numbers, we have to consider if trade continues to slow, exports continue to slow, how much of this is sustainable. And that's, I think, the overarching problem and why you're getting a massive push by the CCP and the Chinese government to really kind of drive in the importance of the dual circulation system. And now when we look at just, total face value of bond defaults, you can see that 2020 remains elevated, through October. But I think it's important to understand the function of defaults. So typically in the past, the PBOC could pick up bad debt, move it to their sheets, provide some liquidity to the banks that are struggling, to the economies, the state-owned enterprises that are important, because a lot of state-owned enterprises become get preferential treatment from the local banks, from the local province. So they're able to get capital that they may not need or they may use unwisely. And then when it comes to an unwind, it's how many people are exposed. So according to creditor documents from the Financial Times, 70 Chinese and foreign banks, as well as trust companies, had about $5.1 billion in outstanding lending to Huchen Automotive Group as of last year, which, based on updates and what we've seen, hasn't really changed that much. Now, the revelation comes as the country's multi-trillion-dollar debt market have been rocked by defaults at government-backed companies. Now, the government's going to choose which companies to let default, because they're like, all right, well, if you default, then it'll show that we're cleaning up the system. But how many problems are just beneath the surface? How much is that asset really worth? Because based on the asset values, there should have been enough to cover the defaulting debt. So but is there? And this is where we get asset valuations. What does the asset bubble look like? What do write-downs look like? How big should write-downs be? And is there enough of a cash cushion at these state-owned enterprises to cover that? So, we've seen from, that there's been a flurry of recent defaults and results in deterioration in asset quality, at Chinese banks. Now, as asset qualities deteriorate, it's a matter of, well, the asset itself, as in the bond, but because the underlying asset or the underlying facility, manufacturing, what have you, doesn't equal to the liability, where there's not enough either revenue or whatnot to cover that interest expense. And because it's a state-owned enterprise, and a lot of the provincial governments need it for not only tax revenue but jobs, they need a certain amount of bailout, and that's where we're starting to get some pressure. And there's this fear of, well, how many of them are going to have problems, because these lenders' operations are heavily influenced by the government, and they have strong incentives to support local SOEs. So gone are the days when Chinese banks could roll over troubled debt indefinitely to make their financial statements look good, which is Weehee from Dragonomics. And it's an interesting comment because it's true. I mean, there was an assumption that, well, the SOEs are safe, they're backed, you can lend to them, and then you got special purpose bonds, you got SOE loans that were mandated, you got an adjustment in terms of the reserve requirements, you got all of these things changing that is hurting the actual value of the company and what the potential is in terms of what they could get and what they could be going forward. And that's where we look at regulator actions and credit spreads. So when we look at credit spreads, there's been multiple defaults. That was just one. The Yongchen was a big one in terms of because this was a financial entity, and you can see that spreads started to rise. And the question is, as spreads started to rise, as pressure started to mount, where does that adjust? So private started to spread, SOEs, central SOEs, and again, local SOEs are local to the provincial. And then SOEs are state-owned by the central government. The FSDC, or the Financial Board, had to come out and say something to try to stem the tide of this widening, because the widening is going to increase overall interest expense. When you roll over your debt, it's going to cost more money because the average bond spread is widening. So if I borrow debt at 3%, now I need to roll it. I now need to borrow at 3.25%. So I'm getting this steepener, which means that my revenue's already been hit because of COVID. I've already overinvested, or assets might not be worth as much as I initially thought. My revenue's falling. So that interest expense means something to me. And these are things that we're starting to see. Now, obviously, the SOEs are starting to get a question, because the central SOEs, they're always going to have the backing of the government, the CCP, but the local side, that's where the government has been willing to let defaults happen, because we can say, oh, well, it wasn't properly managed at the provincial level, and they can kind of pass the buck and help push down while still providing some sort of support. The question is always, what is behind the curtain? Because we really don't know. And that's why there's some hesitancy as we see these spreads rise, as we see debt levels internally go over 360% of GDP, and then we see debt levels rising internationally as China has aggressively lent across the Belt and Road Initiative to achieve Made in China 2025, and now as we've seen the dual circulation strategy. And while all of this is happening, there is a massive trade war with Australia. So Australia was part of the RCEP trade deal, but yet Australia also signed a treaty of an agreement of mutual defense with Japan, all while Australian coal remains stranded in Chinese ports. So China has put multiple tariffs on, or just bans on, Australian goods, coal being one of them. So not surprisingly, Chinese coal prices have increased exponentially as we get this balance and this adjustment. Now, in the report we wrote 2 weeks ago, which is coming out, an updated version next week, we talk about the 14 points that China submitted that their grievances with Australia are. the issues aren't going away, and neither side is going to back down, because China has a position, Australia has a position, Europe has come out and said, well, we need China, we need to trade with China, and they won't always agree with our humanitarian rights. Now, this was said by Merkel. We can interpret that however you want. I have my own interpretation, and it tends to be a little less positive. But Australia, and this is going to be a big test for when Biden comes into the office. I mean, we could still get Trump. I'm just saying that just based on how things sit right now in the news, this isn't a political statement. It's how is President-elect Biden or Trump going to manage Australia? Are we going to take Australia's side, China's side? Are we going to try to find something in the middle? And the way we're approaching this, it seems that we're going to be way more on Australia's position, especially as the U.S. tightens the rules and restrictions of Chinese companies listing in the U.S., the accounting standards, and banning just general activity based on some of the other. We've already kicked some of them off the exchange. We've obviously banned Huawei. This is just the tip of the iceberg, and Australia has had a lot of issues, more so than most, with China because of some let's just say more nefarious components on spying and other forms of espionage, and these are things that, again, Australia is standing up, and I think a lot of people are coming to bat for them, because China has lost a lot of international support given things that have been done in not only in Tibet but in eastern China, as Hong Kong, as among other things. And this is the bigger problem. So yes, we did get a trade deal signed. It's great. It's going to take years to get it approved. And Australia signed it as well, but how realistic is it, given some of these issues that remain and the 14 points that many of them just are absurd? But again, it's just a matter of how do they respond. And I think the former prime minister and others in the Australian government have been very firm in they're not going to back down. And I think they'll find international support for that. So we've already run on too long. I can talk about China and all these intricacies and how it works into all the different components, because it is fascinating, and they are going to be a huge part of oil and energy and the economy going forward, because they are building and have a ton of new petchem capacity, refining capacity. So they're going to import more oil, but export way more product. And how is this going to change the trade flows? And what does that mean for trade deals and just the general Asian market, and as it continues to grow and change and become more robust. So thanks again for watching. I know we covered a lot. Tomorrow we're going to have our OPEC show, and then obviously our favorite, the Primary Vision Frac Spread Count. So thanks again for watching. I'm Mark Rossano, founder and CEO of C6 Capital Holdings, coming to you from Primary Vision Network.